Do you think you got that perspective from like being at a D Shaw where, understanding risk and capital at risk and markets was so important? Because, at Cornell, you're studying mathematics and physics, and it's, again, like you said, it's very easy to go down that cryptography rabbit hole and go analyze it that way. But the perspective from a risk management perspective is one that's not obvious to a lot of people unless maybe you've worked in a firm that lives and dies by P&L and risk.
For sure. I don't think I think D Shaw helped me more on the like understanding cryptocurrency research side of things because they're much more focused on sort of the rigorous research
Okay.
aspect of how they think about both risk and modeling things, etc. But I think when I worked in high frequency trading, that's where I got the real sort of idea, the sort of kernel of like, oh, actually, we should be thinking about these cryptocurrency systems the way high frequency traders think about risk. It's like much closer to that, where, HFT is extremely adversarial. It's like very zero sum. You have like, 10 firms and then, a whale makes a big trade and everyone is fighting to kind of like be the one providing liquidity around it, right? And that is very similar to like how a lot of cryptocurrency networks behave. And so I think thinking about it the way traders think about it, and I really mean much closer to automated high frequency traders, less like the sort of most of the stuff D. Shaw does, or like these bigger asset managers, Renaissance, etc. They don't do super high frequency stuff. It's sort of like medium frequency and very large size. Like they have, $1 billion portfolio and they rotate it into different assets every week or something like that.
Right.
Whereas in high frequency trading, it's much more like, you do a quick trade and you don't have that much capital at risk, but you're sort of like attacking the system in some way that looks more like what cryptocurrency attacks look like. So I would say I learned more about thinking of this type of stuff from HFT than from sort of like D Shaw.
Can you give everybody here kind of like high frequency trading like 101 in like a couple minutes? Because you mentioned some interesting things about it. Again, it probably gets a really bad rap in the market and people probably don't understand what it is and what you can learn from it. But how do you kind of explain like what it is to most people?
Yeah, so I mean, I think the simplest way to think about it is in a market, if prices are really stale, if there hasn't been a trade in a while, then it's really hard for people to trade a lot of size because there's sort of uncertainty. Like, oh, like no one has really wanted this asset for a while, so maybe it's worthless. So in order to actually ensure that markets have very recent pricing, you need people who are posting liquidity, who are adding buy and remove orders, almost like wholesalers. Like, hey, I'm willing to sell you this crate of grapes at $1 and I'll buy a crate of grapes at 99 cents, right? They're sort of like the middlemen who kind of provide inventory. And one important thing is like you want your inventory to be adjusting as fast as possible, because like if you don't adjust your inventory, let's say the price of oranges crashes 10%, now you're stuck holding a bunch of them and like you're getting out of them at a huge loss. So high frequency trading really is about inventory management at a really fast scale so that prices are incorporating as much information about supply and demand as possible. The reason I guess people have a negative view towards it is everyone thinks they're sort of like, being front run. But the thing is, it's an extremely competitive game. So to the point that it has, the fees and sort of profits from it have like shrunk quite dramatically over the last 10 years per trade. But it's basically a way of people doing inventory management, that you could think of it really like they're a wholesaler, but they're a wholesaler for this like asset that exists and, that they're adjusting the prices of really quickly. Right. The reason I say it's HFT, the HFT mindset is closer to the mindset to think of for security and blockchains is because in most trading is fully autonomous. There's sort of you have these algorithms that are sort of competing with each other, and most of the way that people interact with doing different trades is that they maybe interact with multiple venues. So maybe there's an asset in New York, or well, really New Jersey, on NYSE that's supposed to be correlated to an asset in Chicago, in Aurora, it's the CME. Well, then the high frequency trader sort of has two computers on both sides. They see one price change and they go and update their price on the other exchange. In blockchains, you have a lot of that because there's tons of exchanges and there's also tons of chains. And so you have liquidity sources that are on chain and you have liquidity sources off chain, and you have to synchronize all of those to get, kind of like the best information into pricing. And in that sense, it's much closer to HFT than something like statistical arbitrage, where you're like, I just want to buy, Pepsi just went up 10%. I just want to go buy a bunch of Coke. You're not actually like saying how much you care about the price as much as you're saying, I know these two things are correlated. And when Pepsi goes up, Coke's stock price goes up. So I'd want to buy as much as possible, right? It's not so sensitive to like the little like, hey, the price of this moved 1 cent here. I need to move the price 1 cent there. It's a little less fine grained. And blockchains have a lot more of the latter than they do of the former.